Welcome back to the Deep Dive. Today is January 18th, 2026, and we are looking at a company that has, well, it's essentially become the plumbing of the internet economy.
Right.
But the big question we're wrestling with today, it isn't about how cool the technology is or, how nice the websites look. It's a fundamental conflict for anyone looking at their portfolio right now.
Okay.
Is this company an inevitable utility, something the global economy literally cannot function without? Or is it a stock that is priced for absolute perfection, leaving investors with, zero margin for error?
It's the classic tension, isn't it? The difference between a great company and a great stock.
Exactly.
And as, any seasoned investor knows, they're not always the same thing. And the company we are dissecting today is, of course, Shopify.
It is. And our mission today is to strip away the hype. We are not here to talk about how easy it is to set up a t-shirt store in your basement. We are looking at the physics of the business, the cash flows, the protective moats, and the integrity of the management team. We are basing this entirely on a fresh investment analysis titled The Operating System for Modern Commerce, which just dropped today.
And it's a fascinating time to be looking at Shopify. I mean, we are sitting here in early 2026, and they are at a really defining inflection point. They spent the last couple of years cleaning house, getting rid of massive distractions.
Like distractions.
And now we need to see if the machine they've built is actually worth the premium price tag the market is, slapping on it.
Okay, let's get right into the structure of the discussion so everyone knows where we're headed. Part 1, Chapters 1 to 3, Business, Management, and Financials.
Let's do it.
Chapter 1, Business Understanding.
So to really understand Shopify as an investable asset, you kind of have to unlearn what the general public thinks it is.
Okay.
If you ask a random person on the street, they'll probably say, oh, it's a website builder. It's like Squarespace, but for selling stuff. And sure, that's the interface the merchant sees.
Yeah.
But the business reality is that Shopify is the commercial rail of the Western digital economy.
The rail. I like that. That implies vital infrastructure, something you can't just, rip out and replace easily.
It's the operating system. And think about the fundamental difference between Shopify and Amazon. This is probably the most critical distinction to grasp.
Right.
Amazon is a marketplace. It is a gatekeeper. When you sell on Amazon, you are a tenant in their mall. You play by their rules, you use their boxes, their logistics, and frankly, they own the customer relationship.
They own the customer.
You are just a supplier of goods.
Wow.
They hide all of the valuable customer data from you.
So if Amazon is the mall where the landlord puts cameras in your store, watches everything you do, and maybe even opens a competing store right next door,
Which they do.
then Shopify is the independent building contractor who builds your store on your own land and then just disappears.
Almost. But they don't just disappear. That's the beauty of it. They stay and run the electricity, the water, the security system, the credit card terminals, the inventory management. And that brings us to their revenue architecture, which is really a dual engine model. This is critical for investors to grasp because the mix of these two engines determines the company's future margins and its entire growth profile.
Right, let's unpack these two engines then. Engine 1 is what they call subscription solutions.
This is the SaaS core. Software as a service. This is the stable, recurring revenue. Whether you are a solo entrepreneur on a basic plan, paying a small monthly fee, or a massive conglomerate like Mattel on Shopify, plus paying thousands.
Yeah.
You pay a subscription to access the dashboard.
And that revenue is high margin.
Very high margin, and it's incredibly sticky.
Stickiness is a term we throw around a lot in tech. What does it actually look like here? What does that mean for a merchant?
It means once a merchant builds their entire business on Shopify, integrating their inventory, their customer data, their email workflows, their accounting software leaving is a nightmare. It is operational surgery.
You'd have to rebuild everything from scratch somewhere else.
Everything. The switching costs are massive. And that creates an annuity-like stability for Shopify. They know that check is coming next month because the merchant literally cannot operate without the dashboard.
It's just too painful to leave. That's good for business. But here's where it gets really interesting, and I think this is where the real growth story actually lives. Engine 2, Merchant Solutions.
This is the rocket fuel. Internally, they might think of it as the success tax, but, in the best possible way.
A good tax.
A good tax. This captures all the variable revenue. Payment processing, transaction fees, ad revenue, currency conversion fees, shipping labels. Basically, it's a royalty on GMV, gross merchandise volume.
So to simplify it way down,
Right.
Engine 1 is pay us to exist, and Engine 2 is pay us when you sell.
Precisely. And here is the key statistic from our source material that just jumped off the page at me. As of Q3 2025, Merchant Solutions grew 38% year over year.
38%.
It is significantly outpacing the subscription side. Shopify now makes considerably more money when merchants sell than when they just subscribe.
Which is a perfect alignment of incentives.
It's perfect.
Yeah.
They only win if the merchant wins. If you set up a store and don't sell anything, Shopify makes, very little from you.
That 38% growth is huge. It shows that the platform is actually working for the people who are using it. Now, let's talk about the ecosystem, because this isn't just about small mom-and-pop shops anymore, is it? They've got this flywheel going that's capturing much bigger fish.
The flywheel is all about moving up market and expanding the toolkit. You mentioned Mattel. That's part of Shopify Plus, their enterprise solution. They also have Heinz, Glossier, really major players.
So big, stable companies.
Right. And by locking in these big brands, Shopify creates a hedge against the high failure rate of small businesses. We all know most small businesses fail within the first few years.
Of course.
If Shopify only serves startups, their churn rate, the rate at which customers leave, would be horrific. But enterprise contracts are multi-year, huge value, and near zero churn. Heinz isn't going to switch platforms on a whim.
No way. And then there's the consumer side. I feel like people sleep on Shop Pay. To me, that little purple button is just, it's everywhere.
It is the unheralded giant of their ecosystem.
Yes.
ShopPay has over 200 million users as of late 2025. It's essentially a consumer identity layer. It stores your shipping, your billing, your past orders, everything.
I use it all the time. I mean, it turns a 5-minute checkout process of typing in 16 digits and your whole address into like one tap.
And that speed, that speed creates a network effect. Buyers actively look for that little purple icon because they know it's secure and fast.
Right.
So merchants must have it because it creates the highest converting checkout on the internet. If you don't have ShopPay, you are losing sales to friction.
So it creates a loop.
A loop where merchants are forced to use Shopify to access those high-intent buyers who are addicted to the speed of ShopPay. It effectively weaponizes convenience to lock merchants in.
That is a powerful moat. Wow. It's almost a consumer brand disguised as a B2B tool. And we can't ignore the physical world either, their point of sale or POS system.
Right. The bridge to the physical world. Offline revenue grew 33% in 2024. The holy grail for any retailer is unified inventory, knowing that the medium-sized shirt you sold online is the same medium-sized shirt you just sold in the store in Soho, instantly.
So your website and your cash register are talking to each other.
Exactly. Shopify provides that omni-channel operating system. Before this, you'd have two separate systems that didn't talk to each other, leading to, overselling and very unhappy customers.
And finally, because it's 2026, we have to talk about AI. They've got this stuff called Sidekick and Magic. Is this just buzzword bingo to pump the stock, or is there real utility here?
The analysis calls this the era of agentic commerce. And Sidekick isn't just a customer service chatbot that tells you where your order is. It's more like an AI co-founder.
A co-founder.
Yeah. You could literally tell it to, say, forecast your inventory for the holidays based on last year's sales, or write marketing copy for a new email campaign targeting lapsed customers, or even change my storefront theme to look like summer.
So it's actually doing the work. It's not just suggesting things.
It's doing the work. And the strategic value here is that it widens the funnel. It allows non-technical or even operationally inexperienced people to become merchants. The AI handles the complex operational heavy lifting. It removes the, I don't know how, excuse for starting a business.
It lowers the barrier to entry even further. That's huge. Let's zoom out for a second on the market scale. Just how big is this thing now?
It's massive. They power 5 million active stores. In 2025, they processed nearly $300 billion in GMV.
$300 billion.
They are the second largest e-commerce entity in the U.S. with about a 12% market share. They are trailing only Amazon.
Only Amazon. That is quite the position to be in. Okay, so the machine's huge and it works.
Right.
But who is driving the bus?
That takes us to the leadership.
Chapter 2, Management Evaluation.
In the investment world, we talk about founder mode. It's become a popular concept, the idea that founders run companies differently than, hired gun CEOs.
Right.
Shopify is the poster child for this. You have Tobias Lütke, the CEO.
Toby.
He operates with an engineer's mindset. He's a coder at heart. He is optimizing for the long term, not for what Wall Street wants to see next quarter. And then you have Harley Finkelstein, the president.
The other side of the coin.
Exactly. He's the commercial face, the extrovert, the one out there signing the enterprise deals and pushing the offline expansion. It's a very balanced duo. Toby builds the engine, Harley sells the car.
Toby has a really unique reputation. He's not your typical CEO in a suit. But there was a moment, well, over the last few years, where things get a little shaky.
Mm-hmm.
The capital allocation pivot. This is a crucial story arc for anyone holding the stock, I think, because it shows how they handle mistakes.
It is. It's so important. We call it the mistake, or maybe the side quest. From about 2019 to 2023, Shopify tried to build a logistics network to rival Amazon. They bought a company called Deliver for a lot of money.
A lot of money.
And it was incredibly capital intensive, low margin, and frankly, just a headache.
They were trying to own the trucks and the warehouses. They wanted to do the actual physical fulfillment themselves.
Exactly. And it was bleeding cash. It was diluting their beautiful software margins and changing the nature of the business from a high-margin software company to a low-margin logistics company. The market hated it.
I remember that.
But then came the correction in 2023 and 2024. And Toby did something very few CEOs do. He admitted he was wrong, publicly. He sold the entire logistics arm to Flexport.
That must have been a tough pill to swallow, admitting you burned billions on a bad strategy.
It was, but it was a subtractive move that saved the company's profitability. By selling it, they returned to being asset-light and software-focused. And they were smart about it. They kept a 13% stake in Flexport.
Ah, so they still have some upside.
They keep the upside without the operational nightmare. It takes a lot of humility and long-term thinking to reverse course like that.
And that leads right into their culture, doesn't it? This idea of subtractive management.
It's about removing layers to increase speed. Toby talks about this a lot, getting rid of crappy work so people can do impactful work. But there's also an ethical component to their culture that doubles as a business strategy.
You mean their privacy stance?
Their privacy stance. They refuse to share merchant data with ad networks. They are positioning themselves as the anti-Amazon.
Which builds trust with the merchants. If I'm a merchant, the last thing I want is my platform stealing my sales data to make their own private label products to compete with me.
Exactly. It's a trust-based moat. Amazon has a long history of using third-party seller data to launch Amazon Basics products. Shopify promises they will never ever do that. They're the arms dealer, not the army.
So they fixed the big logistics mistake. They have a founder-led culture that seems to work. How does that all translate to the bank account?
Chapter 3. Financial health.
The turnaround, this is the big story, right? We've gone from growth at all costs during the pandemic to profitable growth now.
That is the headline. The most important metric to look at here is free cash flow, or FCF, margin. It is now sitting at a very healthy 18%.
18%.
And they have hit double-digit margins for 9 consecutive quarters. 9.
That is a massive shift from burning billions on warehouses.
Right.
So 18 cents of every dollar coming in the door is now sticking to the ribs as pure cash.
It proves the business model is working. They are a cash-generating machine.
Yeah.
And get this, revenue growth is accelerating too. In Q3 2025, revenue was up 32% year over year.
32% growth for a company this size is, it's really impressive. Usually the law of large numbers would be slowing you down by now.
It puts them in an elite tier. Investors use something called the Rule of 40 to judge software companies. It's a simple heuristic.
Okay.
You add the revenue growth rate to the profit margin.
Okay.
Anything over 40 is considered great. Shopify's at 50%. 32% growth plus 18% margin. That is best-in-class efficiency.
They are an A student, no question. What about the balance sheet? Is it safe if there's a downturn?
It's a fortress. They have $6.3 billion in cash and almost no debt. They have a net cash position. So, high interest rates, not a problem for them. They don't need to borrow. They are self-funding.
And that gives them options.
Total optionality to acquire smaller companies or weather a severe recession without even breaking a sweat.
Okay, so the business is great, the management is smart, the financials are rock solid, but here it comes, the elephant in the room, the price.
The valuation. This is where the traditional value investor usually gets up and quietly leaves the room.
As of this morning, January 18th, 2026, the stock is trading at $155.81 per share. That gives them a market cap of around $202 billion.
And the multiples are, well, they're rich. It's trading at about 115 times trailing earnings, PE, and about 14.5 times sales.
115 times earnings. I mean, that is a lot of future growth already priced in. You're paying today for money they might not make for a decade.
It is a massive premium compared to its peers. But let's look at the discounted cash flow, or DCF, analysis to see what that really means. This is where we try to strip out the emotion and just look at the math.
Right. This is the educational moment. How do we figure out what it's actually worth based on the cash it's likely to produce?
So if you run a base case scenario, assuming they keep growing well but not miraculously, and margins stay healthy, the intrinsic value comes out somewhere between $145 and $160 per share.
So at $155, where it is now, it's basically priced exactly where it should be. It's fairly valued.
For a perfect scenario, yes, it is fairly valued. But there is very, very little margin of safety, as Graham would say.
Well, room for error.
None.
Yeah.
And if you look at a bear case, say a recession hits and consumer spending just craters, the value drops to maybe $90 or $110. On the flip side, if you believe the AI boom is going to change everything and accelerate e-commerce, the bull case takes you up to $180 or even $210.
So you are paying full retail price for a very high-quality asset. You are not getting a bargain bin deal here.
Exactly. You're buying a Porsche, but you're paying the full sticker price for it. You aren't finding it in some barn for cheap.
Which, brings us to the question of how you can get this kind of data for every stock in your portfolio, not just this one.
Right. And this is a good moment to mention, like, and subscribe to Stock Analytics AI.
Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai. For just $10 a month, you get full access to our deep dive video library covering over 500 S&P 500 and Nasdaq 100 stocks, each with full source citations you can verify. Can't find the stock you're looking for? Request analysis on ANY ticker and we'll deliver it within 24 hours. Upgrade to Pro for $20 a month and unlock our SEC risk scanner, which detects red flags in company filings before they hit the headlines, plus our portfolio diversification analyzer to optimize your holdings. Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust. Part 2. Chapters 4 to 7, market sentiment, ownership, risk, and final conclusion.
All right, let's get into the vibe check. How's the market feeling?
Chapter 4, market sentiment.
The vibe on Wall Street right now is, I'd say, cautiously optimistic. The consensus rating is a moderate buy. The average price target is around $179, which implies about a 15% upside from where we are today.
So they think there's a little room to run, but they aren't, screaming buy, buy, buy like they were a few years ago. There's some hesitation.
Exactly. And a lot of that hesitation comes from the macro forces. We could talk about the so-called Trump trade.
Right. The political landscape in 2026 is a big factor.
Traders are weighing two opposing forces here. On one hand, you have the bullish case, deregulation and tax cuts. That usually helps stocks. It puts more money in corporate pockets and consumer pockets.
Yeah.
But on the other hand, and this is a big one for Shopify, you have tariffs. Tariffs hurt cross-border trade, and that is a huge part of Shopify's volume.
So it's a real tug-of-war. What are the charts saying? The technical analysis.
The stock is in what you call a consolidation phase. It had a massive, massive rally in late 2025, and now it's kind of taking a breather, digesting those gains.
Okay.
It's trading below its 50-day moving average, which is around $160, but it's still holding well above the long-term 200-day average, which is in the $134 to $149 range.
So it's healthy profit-taking. It's not falling apart.
Exactly. And the short interest is very low, only 1.7%. That tells us the smart money is not betting on a collapse. They might not be buying aggressively right now, but they definitely aren't betting against it. They seem to be holding.
That's a good sign. But who actually owns this company? Because with some tech stocks, the shareholders are just along for the ride while the founder drives the car off a cliff.
Chapter 5. Ownership structure.
This brings us to the governance reality, which is a big one.
It is. Shopify has dual-class shares. This is critical for anyone who cares about voting rights. Toby Letke controls 40% of the voting power via a special founder share.
40%. So essentially what Toby says goes. It's a dictatorship.
It is a benevolent dictatorship, hopefully. But yes, investors are passengers. You cannot vote him out. If you invest in Shopify, you are explicitly investing in his character and his long-term judgment.
And if you disagree with him,
your only option is to sell the stock. You can't stage a coup.
And who owns the rest of the shares? The non-voting ones, basically.
Institutions own about 66%. Fidelity, Morgan Stanley, the usual suspects. This means the stock moves in lockstep with the Nasdaq 100. If tech sells off, Shopify sells off. It doesn't matter how good their quarter was, they will get dragged down by the index flows.
That's important to remember. What about the insiders? Are they still eating their own cooking?
They own about 6.1%, which is significant. That's billions of dollars of skin in the game. But, and this is important, but we have seen some recent selling by both Toby and Harley in late 2025 and early 2026.
Is that a red flag? Should we be worried?
Not necessarily a panic signal. It's likely for diversification. They have these things called 10b5-1 plans, which are pre-scheduled sales to avoid any accusations of insider trading.
Okay.
But selling at all-time highs does signal that they are content taking chips off the table. They certainly don't think it's wildly undervalued right now, or they'd be holding on.
Right. That's a very fair reading. If the CEO is selling, he probably doesn't think the stock is going to double next week. Okay, we've looked at the good, we've looked at the structure. Let's look at the stary.
Chapter 6. Risk assessment.
We mentioned tariffs earlier, but let's do a proper SWOT analysis deep dive. What are the threats that could actually derail this train?
The biggest red flag in 2026 is, without a doubt, tariffs. There is serious talk of a 10% baseline import tariff and maybe up to 145% for China.
Ouch. Why does that hit Shopify so hard? I thought it was just software.
It is, but a huge chunk of Shopify merchants rely on cross-border dropshipping. They act as middlemen for goods made in Asia, particularly China.
Right.
If you slap a massive tariff on those goods, the merchant's margin gets completely crushed.
Yeah.
If the merchant can't make a profit, they stop selling. If they stop selling, Shopify's GMV revenue drops. It's a direct hit to Engine 2, their growth engine.
That is a serious risk. It cuts off the flow of cheap goods that powers a lot of e-commerce.
Valuation risk, which we've already covered. It is priced for perfection. Any earnings miss, any slightly weak guidance, and this stock could drop 20% in a single day. We've seen it happen before.
We have.
And then there's the walled garden threat.
TikTok Shop.
Exactly. TikTok Shop wants to keep every transaction inside the TikTok app. They don't want you clicking a link to go to a Shopify store. They want to be the mall, the payment processor, everything. If they succeed in blocking those exits, Shopify loses its value as a storefront. It just becomes a back-end database, and that is a much less valuable business.
But it's not all doom and gloom. There are some massive green flags, too, on the opportunity side.
Oh, absolutely. International expansion is booming. Europe GMV grew 49%. That is incredible growth in a mature market. It proves this isn't just a North American story. And then there's B2B commerce.
Business to business.
Wholesale. It is a massive, frankly antiquated, untapped market. It's maybe 3 to 4 times larger than B2C retail.
Wow.
Shopify is aggressively moving into this space. If they can modernize wholesale, which is still mostly done via fax machines and PDFs and emails, the way they modernized retail, that is a huge, huge runway for growth that creates a whole new layer of GMV.
And ad tech. You mentioned that earlier.
Shopify audiences. In a world without cookies, where tracking users is getting harder and harder, Shopify has the best data. They know what millions of people are actually buying.
The ultimate first-party data.
The ultimate. They use that to help merchants run better, more efficient ads on Meta and Google. That is becoming a crucial tool for merchants to survive. It's just another reason you can't leave the platform. It improves your marketing ROI.
So we have tariffs and valuation on one side and international growth and B2B on the other. It's a real balancing act. How do we synthesize all of this?
Chapter 7. Conclusion.
Let's bring it all home. We have the bull case and the bear case laid out pretty clearly.
The bull case is simple, right? Shopify has won the platform war. The logistics distraction is gone. They are a cash-printing machine. AI will lower the failure rate of merchants, making the whole ecosystem stronger. It is an inevitable compounder. You buy it, you hold it for 10 years, you do very well.
And the bear case.
The valuation leaves no room for error. Tariffs are a direct headwind that could crush their core customer base. And the insider selling, while not a panic signal, suggests we are at a local top.
So after all that, what is the final verdict from this analysis?
It is a high-quality business at a fair but not cheap price.
So for the strict value investors out there, the Ben Graham disciples.
Uninvestable at $155.81. You are taking on too much valuation risk for the price. You wait for a pullback. If it drops to the $130 to $140 range, right around that 200-day moving average we talked about, that's your potential entry point.
But for the long-term compounders, the people who are okay holding for a decade and want to own the best businesses.
It's an acceptable entry. If you believe in the durability of this commercial rail, and you believe they can crack B2B, you could start to build a position here. You just have to be able to stomach the volatility. It will be a bumpy ride.
It's the price you pay for quality. Before we go, I want to leave everyone with a final provocative thought. We talked about Sidekick and AI.
This is the part that it really keeps me up at night in a good way.
If AI agents eventually run the store, market the products, forecast the inventory, and handle all the customer service, does the entrepreneur just become an investor in their own Shopify instance?
That's the question, isn't it? If the AI does all the work, The human just provides the initial capital and the creative idea. It fundamentally changes the definition of what a merchant is. And if Shopify controls the AI that runs a huge chunk of the independent economy, well, that $200 billion valuation might actually be cheap.
Something to mull over for sure. That's it for this deep dive.
Like and subscribe to Stock Analytics AI.
And remember, this was all based on independent research. It is not financial advice. Please do your own due diligence. We'll see you on the next one.